Hello, everyone. Good news out of the RBA today. It wasn't the great news that we were hoping for, but it was still good news nonetheless. The Reserve Bank announced that they're reducing interest rates by 0.25%. So, for all of you mortgage holders out there, you're looking at savings anywhere between $50 and $100 per month, depending on your mortgage balance, for the majority of mortgage holders. Considering that 2 years ago, 3 years ago, we were looking at nothing but interest rate rises, it's great to see that now, two times this calendar year, we've already seen interest rates coming down. And the expectation as well is that we'll continue to see rate drops for the remainder of the year, potentially two or three more rate drops before the year's over. So it feels like the easing that we've been waiting for a very long time was finally coming to fruition and picking up steam. So what I might do is just take you through the Reserve Bank's announcement just quickly because there's nothing. It's basically a cookie cutter from the last announcement, but we'll take you through that, and then a couple of articles to share and a couple of calculators to help you make some decisions going forward. Right. So we'll start with the Reserve Bank announcement. Shrink down the screen here. So the Reserve Bank announced this afternoon that inflation continues to moderate. And this is the big key takeaway from the Reserve Bank's announcement. The fact that inflation is continuing to moderate means that if the Reserve Bank sees the economy struggling, or if they see unemployment increase, then they can use interest rate cuts to help stimulate the economy and to help pick things back up a bit faster. In the past, if we saw issues with the economy or with unemployment, because inflation was so high, we didn't have that inflation or that interest rate tool to use. But now it feels like the Reserve Bank has a bit more capacity to continue the easing that we're all looking forward to. So great news there that inflation is back under control. And then everything else here from the Reserve Bank is all pretty standard. And essentially, they're constantly nervous or cautiously nervous, and we'll continue to review going forward as to what decisions they make. So just pretty much the usual from them. I saw this article this afternoon from realestate.com.au, where they're calling 2025 the year of the cuts. And I guess that's fair. If we're expecting to see four or five cuts this year, then yeah, 2025 is the year of the cuts. The new cash rate's currently sitting now at 3.85%, and it's the lowest interest rate that we've had, or the lowest cash rate that we've had in a couple of years. And this sentence here is pretty much what I've been expecting for the last couple of years, in that while the property market, especially in Victoria, has sat sideways or stagnant for the last couple of years because of the pressures around interest rates and borrowing capacity. As interest rates come down and as borrowing capacity increases for everyone, it's likely that we'll start to see home prices increase. And we're already starting to see Victoria trend up in line with some of the other capital cities around the country. Um, this chart here just gives you, I guess, a really quick idea of what the savings will mean for you, or the interest rate cut will mean for you. So, for example, if you've got $1 million mortgage, your current repayment's roughly $6,000, you're going to see a discount of $160 based on this 0.25% cut. If you've got a $500,000 mortgage, then you're looking at roughly $80 per month in savings. All right, so significant savings to the pocketbook, especially when you add in the fact that we've had a rate cut back in February. For the average mortgage holder that's sitting at around that 500,000 mark, for an average balance, $160 a month is substantial as far as savings. So really good to see there. This is the thing to watch for first home buyers and for investors. The two categories where we're still seeing quite a bit of traction and quite a bit of interest. House prices increasing is going to be something that we want to keep an eye on over the next 6 to 12 months. Because as I mentioned earlier, if we're increasing everyone's borrowing capacity and decreasing the cost of a mortgage, then you would expect that there'll be more interest in the housing market. And the hotter that gets, the higher the prices should likely go, or will likely go. And the other thing to consider, in my area in the southeast suburbs, we did nothing but building loans for pretty much between 2010 and 2020. Every single loan was a building loan. And this year, we've seen maybe two or three building contracts come across our desk. So very few homes are being built, and that's just going to put further pressure on the property market. So that's why I think we're seeing a lot of investors coming into the market. A lot of first home buyers are starting to come in because they do believe the price will start to tick up quite a bit. Skipping over to some of the tools that you can use to help get an idea of how this rate cut will affect you. And this pricing tool here will give you a link in the email below so that you can access this yourself and play around with it. But essentially, it's a standard mortgage calculator that's just going to help you identify the savings that you'll have based on the rate cut. So you put in your mortgage balance, let's say $640,000. Let's say that your current rate is 5.95%, and you've got 25 years left on your mortgage. On a principal and interest repayment, you're going to save with a 0.25 rate cut, you're going to save roughly $97 per month or $1,100 per year. So substantial savings there. And if you want to take that further and say, well, what happens if we do get another 0.5% in discounts over the next few months? If we increase this to 0.5, actually it was already on 0.5, so we'll put it back. If we increase that to 0.5, then we're looking at an additional savings of $200 per month. So definitely the more rate cuts we get, the more savings everyone's going to have, the better the borrow capacity for everyone as well. So for all of you existing mortgage holders out there, play around with this calculator. One thing to keep in mind is the term that you have, because the term that you have will affect the repayment required. If you're finding yourself, even with these rate cuts coming in, if you're finding cash flow is still a little bit difficult, one thing that you have the option of doing is increasing your term back out to 30 years. Now, this isn't the smartest financial decision in the short term, in the long term. But oftentimes, when we get into certain life stages where things are more expensive, especially when we're looking to raise children, then usually cash flow is the priority. And we're not so much worried about paying off the mortgage. It's just about getting ourselves through that more expensive period of time. So if you did take your mortgage, let's say you've got a current repayment of 4178 per month on a 24-year term, and you extend that back to 30 years, you've now reduced your repayment by about $300 per month. So something to consider for those of you that might be having a bit of issues with cash flow. We can use the loan term to help improve things. So let's now look at an investment property calculator. And this calculator does a couple of things. Number one, it will help you calculate the cost of buying a property depending on the state or territory that you're looking at. So in this example, let's say we've got a property price and we want to put it at $750, for example. In Victoria, you're looking at roughly $40,000 in stamp duty, transfer fees, registrations. So all up, this is going to cost you about $790,000. This calculator takes another step and it says, all right, well, if you've got an existing home and you want to use the equity in that home to help purchase this investment property. So rather than contributing cash, contributing your savings to help cover the 20% plus costs, you want to use the equity in your existing home instead. Well, let's say that your existing home is worth $850,000, and let's say that you've got a mortgage of $350,000. This is telling you that you've got enough equity in your existing home to help cover the 20% plus costs. So essentially, we're going to borrow $190,000 against your existing home, and we'll borrow what? What does it end up being? We've got here about $600,000 against the purchase property. So this calculator is going to take you through the equity that you have in your existing home, the costs for the purchase, and work out if you've got enough equity to make that work. And you can see here we get a green tick at the bottom that says you do have sufficient equity to purchase an investment property using the equity in your home. And this outlines here the loan structure or the proposed loan structure that we would do for clients where we're borrowing against the existing home to help cover the 20% plus costs. If you are looking for an investment property and you want to talk about this further, please give us a call. This is just, I guess, to try and give you a rough idea if you've got enough equity in your existing house. But obviously, having a conversation with us is going to help us flesh out not just the equity position that you have, but your borrowing capacity. So I think in general, very good news from the Reserve Bank. Very excited to see them giving us a bit of reprieve and a bit of relief in these high interest rates. And the expectation is that we'll see more rate drops come. In the meantime, if you do want a review, we normally do reviews for clients every 6 to 12 months. But if you haven't heard from us or if you want another review done, reach out to us, and we're always happy to speak to your bank and see if we can get your interest rate down. One thing too to note on these rate cuts, we've already seen a couple of the major lenders announce that they are passing on the full rate cut. So Commonwealth Bank and NAB have come out so far and advised that they're passing on the full rate cut as of the 30th of May. So great to see. The expectation is that we'll continue to see every other bank in the market passing on the full rate cut. Uh, when you do get a rate cut with lenders, they don't automatically reduce your required repayment. Normally, the banks will leave your your current repayment as is, uh, and that just means that you're then paying that loan off faster because you're now paying a smaller interest rate or paying at a lower interest rate. But your repayment likely remains the same. If for cash flow reasons you want to reduce your required repayment, then you need to call up your bank or hop onto your internet banking or your phone app and request for this smaller required repayment based on the new lower interest rate. So the rate will get passed on. You will be calculated interest based on the lower interest rate, but normally your repayment remains the same unless you ask for them to lower it. So if you've got any further questions around that, please give the office a call. Anyone here will be happy to talk you through it, but should be pretty easy to do on your own through internet banking or calling the bank yourself. That's it for me this month. We're expecting another announcement. I believe it's early July. So once we do get that, we'll get another video out and let you know where things are at. But yeah, if you need anything at all, feel free to reach out. Happy to chat. Thanks for your time.